A lot of people get excited when we talk about derivatives. Let us understand derivatives with the help of a simple example of a tomato farmer. It is well known that the price of tomatoes fluctuates quite a bit. The price of tomatoes fluctuates from 5 Indian rupees per kilogram to sometimes 100 Indian rupees per kilogram. The farmer obviously wouldn't know the price at which his tomatoes will get sold on the date of harvest. He is worried that the price may be too low. Similarly, a ketchup manufacturer who sells his ketchup at a fixed price would want to buy tomatoes, but would worry that the price of tomatoes may be very high. Both the farmer and the ketchup manufacturer are exposed to what we understand as price risk. The risk that the price may vary adversely to your liking. The farmer is worried that the price would be low, and the ketchup manufacturer is worried that the price may be high. In such circumstances, if the farmer is approached by a businessman who offers to buy his entire harvest at a fixed price of say 30 Indian rupees per kilogram, provided the farmer also commits to sell the entire produce to him at that price, what would the farmer do? The farmer will obviously do some calculations, and if he is convinced that 30 rupees is a reasonably good price, he would probably commit that he would sell all his tomatoes at the price of 30 Indian rupees per kilogram. What this does is it frees the farmer from the risk of the price of tomatoes being low. He is assured that irrespective of the price of tomatoes in the market, he will get a fixed 30 Indian rupees per kilogram. The flip side, obviously, is that even if the price of tomatoes is very high, say 80 Indian rupees per kilogram, the farmer is still committed to supply all the tomatoes at the agreed 30 Indian rupees per kilogram. Why would the farmer want to do this? The farmer is afraid of prices being low. He wishes to protect himself against this risk. The farmer is called a hedger. Hedging is a strategy to protect oneself from risk. Now the question is, why would the businessman offer this deal to the farmer? The answer is because the businessman expects the price of the tomatoes to be much higher than 30 rupees. His plan is to buy the tomatoes at 30 Indian rupees per kg from the farmer and sell it at the higher price, thereby making a profit. However, there is no certainty that the price will actually be high. The businessman takes the risk of the prices being low. What this agreement or contract between the farmer and the businessman does is it transfers the risk which was earlier faced by the farmer to the businessman. The farmer has replaced uncertainty with certainty. The businessman, on the other hand, has willingly embraced risk. The businessman is a speculator. He willingly takes risk with the intention of making a profit. Now, this is an example of a derivative contract. A derivative is essentially a risk management tool. However, for the farmer to protect himself against risk, we need a speculator in the form of a businessman who is willing to take that risk. Therefore, derivative instruments provide a mechanism whereby the risk is transferred from the farmer or the hedger to the businessman or the speculator. Now, the businessman would be able to make profit out of this deal only only if he is able to predict the price of tomatoes accurately, or at least the direction is right. The prices need to be higher than 30 Indian rupees per kilogram. In order for the businessman to consistently make such profits, it requires a lot of knowledge, investment of time, effort, and loads of love. People are often excited to trade in derivatives because they see derivatives as a medium of earning quick money. What the person who is trading in derivatives does not realize is that they are not hedging. They are not exposed to any risk. But by entering into this contract, they are actually speculating on the price of the underlying. This can lead to huge losses. Many times, brokers and commission agents encourage people to trade in derivatives, saying that in a derivative contract, the risks are low and the potential to make profits is high. This is not the case. The dice always seem to be loaded against people like us. Our advice to our clients is to stay away from derivatives unless you are a very high risk seeker and are willing to lose quite a bit of money. Plus, you have the time and the energy to study and invest in derivatives. Warren Buffett once described derivatives as financial instruments of mass destruction. A conservative investor is better off investing in direct mutual funds, direct equity, and more importantly, in heeding the advice of a SEBI registered investment advisor. Happy investing.